Okay, I'm recording. So we're working on chapter 11, okay, budgetary and responsibility accounting, okay. So we have 5 learning objectives, okay. So the first one, we want to kind of understand what is the budgetary control and what is the static budget report. The second, we're going to learn how to develop flexible budgets, okay, and why this is useful. This budget is useful. Third, we are going to use responsibility accounting to the cost and the profit centers, okay. And fourth, we want to understand the performance evaluation for the investment centers, okay. What is the basis? What's the formula? And last one, we're going to explain the difference between return on investment and residual income. Okay, so that's the 5 objectives. So the first one is we start budgetary control. Okay, so one of the key management function is to control the operations, right? That's why we need a manager, right? Recently, I'm going to a gym called Gold Gym, okay. So they have a manager, right, on site, okay. So his job is to make sure the gym runs effectively, right, to control the operation, right, make sure everything runs smoothly. Budget reports are a key component of this function, okay. So normally, okay, you would have this kind of reports as often as needed. Typically is monthly, okay. So this will provide management with feedback, okay. So at the end of each month, okay, the manager receive a piece of paper, a budget report, right. So the manager will have an idea, right. Will have an idea, how the operation compared to the budget, okay. How the operation compared to the budget. So you were not able to see my PowerPoint. Can you see my PowerPoint?
Yes.
Can see it.
Okay. Okay, so you have a budget, and then at the end of the month, you get a report. You can see the feedback, right? Okay, and also this allows you to compare, okay, compare the actual result versus the budgeted numbers, right? You can compare them. So, okay, so when you compare, you see the difference, right? Nothing will turn out exactly to be the same number, right? So you're gonna see the difference, you're gonna analyze the difference. Okay, you're gonna analyze the difference, and you wanna ask the question, why, what causes, what drives this difference? Okay, what is the causes for such difference between the budgeted numbers and actual results? Okay, and then you're going to ask yourself, should I take corrective actions? Okay, is there anything I need to do, right, to correct, right, to make a correction so that to understand the difference? If I need to take any actions, when should I do it? Okay, when should I do it? Okay, and also if you realize there's something, okay, some new information, right? It's not, you need to do nothing, right? Because it could be it's just the new information, right? So then you have to incorporate that new information to the budget for the following period, right? For the following period. So that's kind of the idea of the budgetary control, right? Okay, so let's take a look at this process, okay? So the whole point is this budget control, okay, it's an ongoing process. It's a cycle, right? It's not just a static function. It's not like, oh, at the beginning of the month, right, I'm done with the budgeting control, right? I'm done for the whole year. No, okay? So this is the ongoing process. First, you are going to develop the budget, okay? So in chapter 10, we talked about there are different ways of developing budgets, right? You probably get the lower management teams involved, to seek their inputs, because the other ones probably have better, more accurate information. But at the same time, that's going to be very time consuming. It's going to be very costly. But anyways, first, you may develop the budget, okay? Develop budget. And then you are going to monitoring the actual results, okay? You always compare the actual results versus the budget, right? Okay, you analyze the difference. So why there's such a difference, okay? How come the revenue at U of L dropped, right? Well, it's because the provincial election, right? The government cut off the funding, right, by 40%, right? So you want to know a reason why the actual result is different from the budget, okay? Many companies, right, like this year, right, for the restaurants business, they're gonna see a lot of the expenses will be hacked, right, in terms of the cleaning supplies, right, because of COVID, right? So you have to the consumption of the cleaning supplies is much higher compared to the budget, probably, right? So you need to analyze the difference, and then you want to ask yourself, okay, what should we do, right? What should we do? If you realize that my production cost is too high, right? My sales number is too low. So then the corrective action would be, I need to cut down the cost and increase the sales, okay? And then you're going to change your future plan, right? The next time when you sit together to develop the budget, right? You have to incorporate that action, right? How can you increase the sales and reduce the cost, right? You have to, because you have learned something through the operation, right? You have learned something, and that information is going to help you to build the future plans, okay? So, and then, this is kind of the cycle, right? And then this is ongoing process in the next period, right? Again, you compare the actual numbers, you notice some difference, and you want to ask yourself, what should we do? And then you may consider that into a future plan, right? Okay, so you are not done. This is just not a one-time shot, right? This is like ongoing process, right? Ongoing process. Oh, do you like this? Do you like what I'm doing here? Is this pretty cool? Okay, anyways, yes, thank you, Tammy. Okay, so budgetary control. So this would work best if you have a formalized reporting system, okay? So on the report in that system, information system, you want to indicate the name of the report, how frequently this report is presented, for what purpose, and to whom, right? So we are trying to include all this key information: name of report, frequency, purpose, and the recipient, okay? So I'm going to use this example, this sample on the table to illustrate this system for manufacturing company, okay? So suppose I'm going to ask you a question. Oh, okay, yeah, thank you for letting me know. So I'm gonna ask you a question. So this is a manufacturing company. For sales report, they are going to show it presented weekly, okay? For what purpose? For what purpose? Those of you who still need a participation mark, for what purpose? And to whom? Torsi?
To know whether sales are being met.
Pardon me?
To know whether sales goals are being met.
Okay, and to which person?
Like the management, the top management.
Okay. So there are, so when you talk about top management, right, there are different people like CEO, CFO, right, VP sales, VP production, right? There are different top management teams, right? So who is going to review this? Rachel?
Like for the sales report, it's weekly to make sure like sales goals are being met, like Tosin said, and it would be like your top management and sales managers. So anyone who kind of oversees directly in that sales
Okay.
area.
Okay. So we want to make sure the purpose is to see if the goals, sales goals target has been met, right? The primary recipient would be the top management and the sales manager, right? The sales manager, okay? So next one, labor report, okay? So the frequency is weekly, okay? What's the purpose for that? Tammy?
Okay, that will be to help to monitor the cost of labor,
Okay.
direct or indirect, and I think the production or the head of the production department could be in charge of that, or
Okay, yeah, that makes sense. So you want to control the labor cost, whether it's direct or indirect, and the vice president of production department managers, they probably want to see this. Okay. Scrap daily, right? Scrap daily. So for this one, what's the purpose? Ashley?
I'm going to take a guess actually on this one. I wasn't trying to raise my hand. For scrap, the purpose would be to pretty much know your cost of what you're, what's the word I'm trying to think of? That you're wasting.
Okay, yeah.
Like wasteful costs.
Mm-hmm. Yeah, that's good.
And then primary, I'm assuming would be each department, because depending on the department, each scrap would be different.
Okay. So for mostly for production, right? The waste, so basically the scrap, they are talking about the raw materials, right? How these materials can be efficiently used, right? So the production manager, they want to make sure that my workers are not wasting my materials, right? So that's what kind of the information we have here. Okay. My friend used to have a factory in China. They are doing customized, customized metal pieces, right? So what happened is, when the order came in, they all in different sides, right? So the workers, sometimes they just set up the machine for the wrong size, right? Then they start doing they start making the production. So what happened is, after 2 hours, they realize that it's all wasted, right? It's the wrong size. So so that's really important, right? Yeah, that's really important. I think that's his company's problem. He's making quite $10 million of sales a year, but he does not make any money because of this the waste on the materials. Okay, so it's very important. No wonder you want to have a daily, the frequency, right? Every day you want to see a report. Make sure you have good control on the use of the materials. Okay, departmental overhead cost monthly. Let's see, Maddie.
Would it be controlling the overhead costs?
Mm-hmm.
And then would it be the department manager that would be in charge of the overhead?
That's exactly right. Thank you. Selling expenses. This is monthly. Let's see. Sue?
Oh,
Sorry.
the selling expense, and then for primary it'd be the sales manager.
Okay, very good. Control selling expenses, sales manager. Okay, and the last one, income statement, monthly, quarterly. Janaya?
The purpose would be to determine your if your income and objectives are being met, and your primary recipient would probably be your top management to make sure that's all under control.
Okay, okay, that's good. Awesome. So now you see the idea, right? The name of the report, how frequent, the frequency, right? How frequently that is reported. The most frequent report is the scrap report, right? What's the, for what purpose, right? And who wants to see this? Okay. Okay, so static budget report. So basically, when we are saying static, that means that when we are doing the projection of the budget data, we are only using a single level of the activity. Okay, just a single level of activity. Okay, and this number typically from the master budget, right? This number, this level of the activity is pulled from the master budget. Okay, when you compare the actual result, okay, you actually compared it with the budget data from the master budget. Okay, so you have an actual result, you compare the actual result with the data from the master budget. Okay, what does that mean? So here is one example. We have sales budget, okay, for first quarter, second quarter total. So, and the budgeted is the first row, and the second row is the actual numbers. And then the difference is budget minus actual, okay? So, if you take a look at the first quarter, okay, when we compare the actual 179,000 with the budget 180,000 sales target, so it is, the difference is $1,000, okay? And it's U means unfavorable, right? Unfavorable. You are hoping you have a sales target of 180,000. Of course, it's more desirable when you sell more, right? So if this number is smaller, the actual number is smaller, right? So it's unfavorable, right? It's off to the undesirable direction. That's unfavorable, right? So it's less than the budget sales number, so it's unfavorable, okay? And the difference is called a variance, okay? It's called a variance. So this will be $1,000 unfavorable variance, okay? Okay, so the difference between the actual and the budgeted numbers, the question you want to ask is, does that difference reduce operating income? Okay, there's a difference, right, in a number. Does that difference reduce the operating income? If you answer yes, this variance is considered unfavorable, right? Because the bottom line is you want to maximize your operating income, right? If the difference reduces the income, the operating income, so it's unfavorable, right? If the answer is no, okay, then it's the opposite. So this variance will be considered as favorable. Often you just use F, and unfavorable you just use U, okay? Oops. So what kind of difference will be in this category? When your sales, actual sales is less than budgeted sales, right? When your actual sales number is lower than the budgeted sales number, that's gonna reduce your operating income. So that's unfavorable. Another situation is when the actual cost or expenses is more than the budgeted cost expenses, right? Your cost is higher. That's gonna also reduce your operating income, okay? So basically, this is a scenario that you didn't sell as much, but you spent a lot of money, right? You spend more money on your cost, right? But you didn't have as much as have the same level of the sales you are hoping, right? So when the sales is lower than target, it's unfavorable. When the cost is higher than the target, it's unfavorable. Okay, and then this is the totally opposite situation, right? We are talking about the favorable difference. Favorable difference means you sell more than you hope to, right? So the actual sales is more than budget sales, or you save the money, right? You saved on the cost. So your actual cost expenses is lower than budgeted, right? You didn't spend as much as you would think, right? So this would be the favorable situation, okay? So do we have any question on this?
No, it's clear.
Yeah, is this pretty straightforward?
Yes, it is.
Okay. Okay, so we just have seen an example, right? In that example, the sales is $1,000 and lower than the target, right? So that would be this situation, right? We have actual sales 179,000, lower than the budget sales 180,000. Therefore, this is considered as unfavorable, right? Okay, so the next step would be, do you want to investigate, is this variance significant enough, the $1,000? Should we investigate, to see what causes this difference? Okay, if it costs you, like, say, $2,000 to do the investigation, to try to understand $1,000 difference, that doesn't make sense, right? You have to consider cost and benefit, right? You have to consider cost and benefit. I'm not sure if I have ever shared with you about the story that, as an accounting student, right, sometimes you really hope that, you have your balance sheet perfectly balanced, right? I remember in my first job, my balance sheet is off by probably like 2 cents or 3 cents, okay? And I was trying to spend half an hour to figure out where that number is off, right? So that doesn't make sense, right? Your client pay you like lots of money for your time, right? You are not just trying to help them to figure out the 2 cents, 3 cents difference, right? So the cost, the benefit, that's relevant, right? So you have to make a decision. Is this difference significant enough to worth my time, worth my investigation? So we assume that the $1,000 unfavorable sales variance is immaterial, so we don't take any further action, okay? Now let's take a look at the second quarter. Okay? So you can see the second quarter budget, the sales is 210,000. The actual is 199,500. So we have an unfavorable variance of 10,500, okay? So this is actually 5% of the budgeted sales, okay? This 10,500 is actually 5% of the 210,000. So now we consider this is quite significant, okay? We should, make further investigation, okay? Okay, so when do we use the static budget report? Okay, so you can see this is static, right? Static means it doesn't change, right? It's fixed. So therefore, it's good. This budget report is good for cost that is fixed. Okay, it's not good for variable costs, right? Because for variable cost, really depending on the level of the activity, right? And the static budget report only deal with a single level of activity, right? So therefore, the uses, right, is really about if you are dealing with a report of a fixed cost, right? For example, if it's a fixed manufacturing overhead cost, a fixed selling and general cost, so that would be appropriate, right? So who didn't mute? Okay, let's take a look. Okay, so so basically, the static budget report, because it's really one single level, right, of activity, right? So it handles fixed cost better, right? So when you reporting variable cost, then this one will be tough, right? Because it does not deal with different levels of activities. Let's take a look at this question. The limitation of a static budget is okay. Santiago.
C.
C. Data at one level of activity. Xudong.
B.
B. Timeliness and specificity. Okay, Ruben.
B. B.
B. The
Yeah,
limitation.
I said
Okay, the limitation
B.
of. So the second or the fourth?
B, not D.
Okay, second.
Like the second, yeah.
Okay, that's interesting. Rylan.
I'm gonna go with C.
C. Tammy.
It's C.
Jimmy.
C.
Thomas.
I think it's C.
Haley.
C.
Patricia.
C.
Okay, so C. Let's go with C. The budget is only dealing with one level of activity, right? A single level of activity. Let's take a look at this question. So when you know your answer, just send me a direct message, right? So don't let other students see. If you are done, just send me a private message. Tell me your answer, okay? Okay, thank you, Santiago. Thank you, Karen. Thank you, Ashley. Thank you, Rachel, Jimmy, Ruben, Haley. Tammy. So now I think it's everywhere. I have people answered A, I have people answered B, I have people answered C. So nobody answered D. Can anyone answer D so that we have a full spectrum? Okay, so who answered C? Can you explain why it's C?
Well, your actual sales are more than you budgeted, so it will be favorable. Your
yeah, that's right. So the sales is higher, right? The actual number is more than the budget for sales, so that's favorable for sales.
your fixed SG&A, can't remember what it stands for. Is less than you budgeted, so it's favorable, and then your fix is more than your Yeah, your actual fix is more than your budgeted, so we unfavorable.
Yeah, exactly. Very good. Thank you. So the answer is C, right? The answer is C. So your fixed cost, right? The actual number, the fixed manufacturer cost, the actual is 455,000, more than the budget 409,000. So that's unfavorable. Okay. So now you ruled out unfavorable. So you ruled out B. Oops. So you ruled out B and D, right? Because we know fixed manufacturer cost is unfavorable. For the fixed selling, general, and the mean expenses, the actual is lower than the budget. So that's favorable. So you only have C. Okay. So flexible budget, okay, flexible budget. So previously we talked about the static budget. It's only one level of activity. So for this flexible budget, they allow various levels of activity. Okay. This can be very useful because if your operating condition changed, right? Before, when you budget, you think the level of the activity is only like 10,000, right? But situation has changed, right? Maybe because COVID, your level of activity of producing the mask is like tripled all the time, the production, right? Before in your budget, you think I'm only making 10,000 masks, right? But then COVID came, you had to make like 50,000, right? So you see that because of the operating conditions changed, right? So your actual result will be different from the budget just because of the level of the activity has been different. Okay. So this will be very useful to assist management to analyze and control variable cost. Okay. For the variable cost, this will be the flexible budget will be very useful. And we're going to see why. Okay. We're going to see using an example why that's the case. Okay. So in this example, okay, this is the static overhead budget. Okay. So the level for the budget is 10,000, and that's the cost for the overhead, 1.1 million. Okay, but that's a static budget, and that's for one level. The level is 10,000, but the actual numbers are this, right? You take the difference, you realize, well, boy, all this U, right? This is not good. You don't want to see U, right? U means unfavorable. But when you compare the actual result versus the budget, so all these cost numbers is higher than the budget, right? And so this difference are unfavorable, right? Variance. But then you think, well, this is bad, right? This is bad. But don't forget one thing, right? The actual result is at a 12,000 production, right? If you produce more, of course it's going to cost more, right? If you produce more, it's of course the cost is going to cost more, right? So how can you tease out this, right? So how can you tease out, how much is this difference is due to the change in the level of the production, right? And how much is due to some other factors, right? You are trying to understand, right? So then you see the limit of these budgets, the static budget, right? Because it's only have one level, right? It would be nice if for the budget they provided a level of 12,000. Then you can compare, right? So, okay, you just have to figure it out. We are going to need a flexible budget. Okay, we are going to need a flexible budget. So how are we gonna deal with this flexible budget? Okay, we have to determine the budgeted per unit cost. Okay, so we have to figure out the unit cost for the variable cost. For the fixed cost, we assume, in that budget range, it's a relevant range, the fixed cost doesn't change, right? So we don't have to calculate the unit cost of the fixed cost, just the variable cost, okay? And it's very easy to calculate, right? Budgeted cost divided by budgeted units, that's the variable cost per unit. Okay, so we know the cost numbers, and we know the budgeted units numbers is 10,000. So we figured out for each unit, 25 for indirect materials, 26 for indirect labor, and 19 for utilities. So that's how I figured out the budgeted variable cost per unit. So now I can compare apples to apples, right? Because the actual level of the production is 12,000. So I'm going to compare to the budget at 12,000, the level of 12,000. How should I do it? I figured out the units. I figured out the unit cost, 25 for materials, 26 for labor, 19 for utility. So these numbers will times 12,000 to figure out the cost, okay, the budget cost. Right? That's for the variable. Now take a look at this. Now this is all F, right? I know F is not a good number you want to see, right? F normally means fail, right? So you definitely don't want to see F in your academic transcript, right? But here means good, favorable, right? We should be happy to see in the budget report when we see F, that's favorable, okay? Now you can see it's all favorable, okay, here. So that's interesting because if you just follow that static report, when you compare 12,000 versus 10,000, all these numbers are unfavorable, right? But now you realize, oh, actually we are doing pretty well, right? Okay, and for the fixed cost, again, this number doesn't change in the relevant range, right? Remember, when we talk about the fixed cost, the cost behavior, we are saying under certain relevant range, the cost does not change accordingly with the level of the activity. That means it's a fixed cost, right? So therefore, we assume that this 10,000, 12,000, this is still in the relevant range. So the fixed cost doesn't change, right? So there's no variance. But all these variants are favorable, okay? All these variants are favorable. Okay, so the total variance now is $8,000. It's favorable. In the previous chart, it's a 132,000 unfavorable. Okay. And the difference is, what's the difference? The difference is 140,000, right? When I compare this versus, does anyone know why it is 140,000? See the 8,000 favorable minus the 132,000 unfavorable. So the difference between these two models is 140,000. Does anyone know why it's 140,000? Ruben, wow.
Because the change in production in units is 140,000 times, or like the $2,000 or unit difference times 70.
Ruben, you are awesome. That's correct. Yeah, good job.
Yeah.
Awesome. So
Thank you.
very good job. Yeah. So here 25, 26, 19, right? So for each unit, the cost is 25, 26, 19, that's 70. So each unit, the cost is 70, right? If you produce 2,000 units more, your cost is going to increase 140,000, right? That's why if you compare 12,000 versus 10,000, you see that difference, right? You see the difference is 8,000 minus 140,000. So that will be 132,000 unfavorable. Okay, good job, Ruben. Okay, so that's this one, and so management now can focus, right? So why this is favorable, right? So basically we can see that you can see this the good result comes from indirect materials 5,000, utilities 3,000, right? So basically the price for the indirect materials is cheaper. The actual price is cheaper than what you think. The utility is also cheaper than what you think, okay? Okay, does anyone have any questions? Okay, I will count to 3, 1, 2, 3, and then please raise your hand if you are good with this, you understand this. 1, 2, 3, sum up. Okay, very good. Okay, awesome. Okay, I'm happy you are following me. Okay, you are following me. I'm happy. So let's take a look at the steps to develop flexible budget. Okay, so first you identify what is the activity index and what is the relevant range of the activity. Okay, so this is something we know already when we learn the cost behavior, right? Do you still remember what's cost behavior? Okay, and then second, you identify the variable cost and you figured out what's the budgeted variable cost per unit of the activity for each cost. Okay, you figure out the variable cost and what's the budgeted variable cost divided by the units. So that's your budgeted variable cost per unit. And then you want to identify the fixed cost and determine what's the budgeted amount of the fixed cost. And number 4, you prepare the budget for selected increments of activity with the relevant range, right? So it could go from, let's say I will go 1,000 increment, right? So 8,000. If it's 1,000 increment, I go 8,000. That's the level of the activity. I will go up 9,000, 10,000, right? 11, 12. So if I know that relevant range is between 8,000 and 12,000, okay? So it will be very clear once we do this. Here's one example. So this is the manufacturing overhead cost for finishing department. So the master budget expected operating capacity of 120,000 direct labor hours. Okay, so what is the activity index in this scenario? Ashley?
Sorry, I want to say wait, you said activity index?
Yeah.
Would that not be your direct labor hours?
Yeah, that's correct. Yeah, good. Thank you. Yeah. So the direct labor hour would be your activity index, right? So the level would be the static level is 120,000, right? 120,000. And you know the cost, right? This is a variable cost, and this part are the fixed cost, right? So the second step, you are going to figure out what's the budgeted variable cost per level, right? Per direct labor hour. So that's easy, right? Use these numbers divided by 120,000. For the fixed cost, it would be the same, right? This would be the same. This is the budget numbers. So we know the activity index is the direct labors. and we suppose identify the relevant range is 8,000 to 12,000 direct labor hours per month. So that's the range, right? That's the range. And then the variable cost per unit, you use cost divided by the level 120,000. You figured out all these units cost, okay? And the number 3, you figured out the fixed cost, right? This information is given, that's the fixed cost, right? And number 4, you prepare budget for selected increments. We are, let's say we are going by 1,000. So 8,000, 9,000, 10,000, 11, and 12, right? So here would be my budget, right? This is my flexible budget. So I'm dealing with different levels. So from 8,000, 9,000, 10,000, 11, 12. And this part is easy, right? Fixed cost, this is all the same, right? This fixed cost doesn't change because the relevant range is from 8,000 to 12,000. In this range, the fixed cost doesn't change, right? And the variable cost is easy, right? You use the unit cost times the level of the activity. So 1.5 times 8,000, 12,000. 1.5 times 9,000, 13,500, right? It's just going like that, right? Okay, so do we have any questions on this? So let's do this again. If you understand this, I will count 1, 2, 3. 1, 2, 3, hands up. Okay, good. Oh, awesome. Okay, do you guys find the chapter 10, chapter 11 are easier? Is that how you find it's easier, these chapters?
Chapter
To me,
11.
yes, anyway.
Chapter
Okay.
10 is a lot to learn for sure,
Okay.
though. The
Yeah.
math is hard, though.
Okay, thanks. Yeah. But I'm happy that you guys are following along this, right? It seems overwhelming, right? Like lots of information, but it's really quite simple, right? When you break it down, it's quite simple. Yeah. Okay, so if you use a graph, right? If you present this flexible budget data using a graph, so the activity index is on the horizontal axis, right? So this is the in thousands, direct labor hours in thousands. Oops. Hussein, are you trying to, how can you, I don't know, you can even draw on my screen?
Oh, sorry, by mistake.
Oh, wow, I didn't know that. You can even draw a picture on my screen. Can you
It's my
maybe
first time
remove
I
it?
joined from my iPad because I'm
Okay.
not at home.
Can you remove it?
Yeah, I'm gonna remove it.
Okay. So you can see that this is the horizontal axis, right? And then the dollar value, right? This is the vertical axis, right? That's the dollar value. And then you have a fixed cost. That's the straight line, right? That's the straight line across all these activity level. And then you have this picture, right? So you can see that this red line would be the total budget cost line, right? So you have this green under the green, this green area, that's the budgeted fixed cost, and the yellow area is the budgeted variable cost. So the red line is actually total budget cost, right? And then you are saying that you are going to budget, 10,000 to 12,000, right? You can see the cost, right? You can see the cost. So this is just the graph, right? Just the graph. Okay, let's work on this question. So who haven't answered the question? We still have a few more lectures. If you believe you can still make it for the participation mark, please participate, right? we still have, let's see, how many lectures do we have? One, including this one, 1, 2, 3, 4. Do we still have 5?
I think so.
Yes.
Yeah, so if we including this lecture, we still have 5. So if you participate in each of these, you can still get 5 more marks, right? So if you are at 5, definitely you want to participate in each class, right? I see some hands up, but I just want to give the other students an opportunity who haven't participated yet.
Is it okay if I sent mine in the chat, like to you?
Pardon me?
Is it okay? I sent my answer to you in the chat.
Sure.
Like
yeah.
two.
Okay, sure. Yeah, if I don't call your name, you want to let me know an answer, that's fine. Yeah. I saw these students with hands up, they have already participated already. So I'm just Hussein, maybe you haven't participated yet. Hussein?
Sorry, I'm having trouble with my iPad.
Yeah.
I'm not sure, but I believe it's all the above because
yeah, that's correct. Good job. Yeah, that's D, all above. Yeah, good job. Yeah, so we just did this, right? First, identify activity type, index, relevant range, variable cost and variable cost per unit, fixed cost, right? And then, yeah, all of above. Yeah. Okay, let's work on this one. Oh, by the way, if you guys review the previous chapters videos, I would really appreciate if someone can, so if you guys can help me to take a note of the timestamp. So far, I only have information for chapter 7, and I don't have time myself to go back to watch the video. So if you guys reviewing these materials, if you can please take a note, I would really appreciate. So far, Jimmy helped me with the chapter 7. For the other chapters, I'm hoping to provide more information on that, but I just don't have time myself to rewatch the videos. If you can do it, I would really appreciate it. And send me an email, please. I know if I say, if you do this, I will give you a bonus mark. And then many people will do it, right? But I won't do that. I just want to count on your goodwill, okay? Okay, so I will give you 3 minutes to work on this. 3 minutes to work on this. Do you have an answer? Florence.
I got C.
C, okay. Yeah. And who else? Hallie?
I got C.
Okay, thank you, Hallie. Okay, thank you, Kate. Okay, so the answer is C. Oops. So the answer is C. Okay. So why? So this is how I do it, right? So I'm going to do it this way. So for the variable cost, okay, so we have 3.5, 8.995, 4.10. So if I add these two, so 8.95 plus 4.10, so this is gonna be 13.05. So 13.05 plus 3.5, that's gonna be 16.55, right? 16.55 per unit. So for how many units? 10,000 units, okay? So I would have 165,500. But don't forget, that's just the variable cost. You also need to add the fixed cost, 100,000. So that's why it's 265,500, right? That's this number, okay? And the same idea, you use 16.55 times 14,000 and plus 100,000, you would get this number, okay? Can we move on? Okay, awesome. Thank you. Okay, so here we have, so for flexible budget report, okay, we have two sections, okay? For this flexible budget report, it has two sections. The first one is the production data, right? This is the selected activity index, direct labor hours, right? And you can see this in this section, it talks about the actual, right? The actual is 9,000 direct labor hours. So you see the activity index right here. And the second part is the variable cost and fixed cost. Okay, so two sections. At the top, you have to make sure you indicate what's the activity index, right? And so then, that's how it works, right? This is the two sections, the top one and then the bottom one. Okay. So this flexible budget report, okay, the people use it in production and the service department, okay. So basically they want to evaluate the manager's performance, okay. Are they control the cost very well, right? Are they control the cost very well? You can see these are the costs, right? These are the costs. So if I see this report, I see that overall there are two favorites, right? So overall there are $400,000 favorite. So I should be happy with the performance of the manager, right? However, I will look into the indirect labor, right? The indirect labor. Okay. How come? Oh no, sorry. Indirect labor is favorable. I want to see indirect materials. So there is overspending 500 and the utilities overspending 100, right? But that's probably easy to see, right? Maybe just the rate has gone up, right? So you think about the construction materials, right? It's very expensive, right? So the housing market, right, is very expensive nowadays. Boy, I don't know. Yeah, I would Yeah, I would never thought like my house will worth more than $1.5 million. Okay, so it's absolutely so crazy. Boy, I don't know how the young generations they can actually purchase a house. Okay, it's yeah, I don't know. I'm hoping that you guys will all work hard. Okay, you develop your skills so that you have a well-paid job, right? You start your own business, you have a smart idea, so you can. But if you just take a regular job, right, it's gonna be, I don't know, it's gonna be very challenging. This is a flexible budget report. Okay, so the responsibility accounting concepts. Okay, you would find this is very boring. Okay, because it's all fluffy stuff. I cannot show numbers. Okay, so but I will try my best, right, to cover this topic. I would even attempted to ask you guys to read it by yourself, right? Because you probably can read it better even than I read it to you. So the responsibility accounting concept. So basically, you know, the managers, they were given authorities, right? So they have the authorities to purchase something, right? To order something. They have the authority to hire somebody, right? Okay. So the whole idea is that you know, the managers, they have the responsibility, right? And you have to somehow hold them accountable, right? So that's why we are here. We are using the words of responsibilities, right? So you set them a budget, right? How much money you can spend. This is a budget, and then they are going to evaluate you based on whether you have you know, achieved the budget. Okay. So for example, right, when I was hired by the university, okay, I want to negotiate with my salary, right, with the dean, right? Another university is paying me much more, right? So I bring that contract to the dean. I said, well, you know, can you please match up, right? So I want to come here, but you didn't pay me enough. See, this is a different job offer from another university in Ontario, right? They are paying me more. So I want you to match it up, right? But what happened is I couldn't get the amount of the match I hope, right? Because the dean, he has a budget to work with, right? The dean is responsible for that budget, right? He has only so much money, right? And you know, employee salary cost is a major cost, right? But he also have a budget on relocation, right? So in fact, I get some money from the budget from the relocation, right? So I probably get $25,000 just because I moved from Ontario back to Alberta, right? So the idea is on that category, on the salary category, the dean really, he has the authority, but he can't overspend, right? But he has another budget that is for moving, right, expenses. He's able to, you know, she's able to give that to me, right? So the whole point here is, you know, whoever the person have the authority, they will hold accountable for their behavior, for their decision, right? They have to be careful in terms of spending the money, right? And this is also from different levels of management, right? It doesn't have to be at the dean level, right? Maybe accounting department chair, right? Maybe there are some kind of budget for each different department, right? Maybe accounting, finance, right? So the whole point here is that in order for this to work, right? So the revenue, the cost has to be directly controlled by that management. If he has no control, it's unfair to hold this person accountable, right? Right. So the whole point is that, you know, this revenues cost in the picture has to be controllable, right? In order for it to make sense, right? So, you know, university, let's say Mike, right? President Mike, he should not be held accountable for the revenues, right? The government cut off 40% on the funding, right? From the government. He has no control, right? It's not because he did a poor job, we lost the 40% of revenue, right? This is something totally beyond his control. So he should not be held accountable for that loss of revenue, right? Okay, so the whole point here is, you know, when you are applying this concept, the revenue, the cost has to be controllable, right? Okay, so the budget data can be developed to evaluate the manager's effectiveness, right, in controlling the cost and the revenue. So only under those situations, you can use that budget to hold the manager accountable for that budget. Okay, this is very useful, especially valuable for the decentralized company. Okay, that's where even the lower level of managers, they were given certain authorities. Okay, so you know what's centralized versus decentralized mean? Centralized means it's a top-down approach, right? So decision is all made on the top, rolled down, right? But decentralized means it's more flat, right? So even the lower level of the managers, they have authorities to make certain decisions, right? And this would work on both profit entities when you try to maximize your net income. Okay, so for the for-profit enterprises, right, you want to control revenue and the cost, so you try to maximize your net income. For the not for-profit entities, right, you need to control your cost, right, because maybe you can only tap into so much amount of donation dollars, right? If you are a charity, right, you have to make sure that you don't overspend your money, right? Okay, so when you compare responsibility accounting versus budgeting, okay, the difference is for responsibility accounting, they distinguish controllable versus non-controllable, right? So if it's not controlled by me, I'm not responsible for it, right? For budgeting, remember the section, you have a variable and a fixed, variable cost and fixed cost, right? And for the responsibility accounting, they only report the items under the manager's control, right? If it's beyond his control, it's not relevant, right? But for the budgeting, they are reporting all the items, right? All the items they are reported, okay? Okay, so controllable versus non-controllable revenues and the cost. For controllable cost, so this cost incurred directly by a responsibility level are controllable at that level, okay? The university hire professors, right? They have already a collective agreement with the union, right? How much, what level of professors at what level of salary, right? It's predefined, right? A non-controllable costs indirectly incurred and allocated to a responsibility level. The managers have no decision over the allocation. Okay, so basically, suppose that let's say MNP, right, the accounting firm in Lethbridge. Okay, so they have a staff, a person. She is responsible for the Atlantic area, right? Because MNP is a national office, right? So they have offices across Canada. So they have some kind of operational manager for different zones, right? So they have a CEO, they have VP, right? Under CEO, they have a VP operation. Under VP operation, they have regional managers, right? So there's the regional manager for Atlantic, right? It's far away from Alberta, but that manager is actually located in Lethbridge, right? So how about the cost, right, for her? The salary is to pay to her, right? That's uncontrollable cost to MNP office, right? Because, you know, they have no say, right? Whether they have no say, they just have a person came, but that person is responsible for, you know, it's a regional manager, right? So it's actually the cost, the salary is not controllable by the MNP office. It's from the top, right? It's from the headquarters. They make a decision, right? Okay, how are we doing with time? I still have 4 minutes. I know this is all fluffy stuff. Responsibility accounting needs performance valuation. So if you do not hold them accountable, right, then it's not useful, right? So they have to be accountable. So the performance report should contain only the data that is controllable by the center, okay? So for MNP, right, if you hold the MNP manager accountable, he should not be responsible for the salary paid to that regional manager for the Atlantic zone, okay? And you want to provide accurate, reliable budget data, right? So you make sure that the budget is fair, right, for the manager. If you know, Lethbridge is still like it's still a small commercial center, right? It's nothing comparable to the Calgary office, right? So the budget cannot be too aggressive. You can't be comparable to the Calgary office. So highlight a significant difference between actual result and the budget goals. Okay, so I'm going to stop there. I will continue on Thursday. Okay, so please stay if you have a question. If you don't have a question, class is dismissed. And thank you very much for you guys are being very awesome students. Okay, and you guys are, you know, working very hard. I'm so happy. Okay, so keep working hard. Okay, have a wonderful evening and I'll see you on Thursday.
Thank you.
Thank you.
Bye.
Thank you.
Bye-bye. Thank you.
Thank you.